Hi, this is Tracy, and this is the online lecture on the financial statements. Now, in your exam, what you're going to have to do is take a trial balance, which will be provided to you, and basically complete some financial statements. Now, what do we mean by the financial statements? Well, that can be split into two parts. First one being your profit and loss account. And sometimes you might hear this called the income statement. If you do hear it called the income statement, that's under IFRS, that's International Financial Reporting Standards. Profit and loss account is still the term we use under UK GAAP. The other financial statement you need to be aware of is the balance sheet. And again, that has a name under IFRS. Slightly different, it's called the Statement of Financial Position. So in your exam, what you're going to have to do, as I say, is take this trial balance, figure out, do the balances feature in my profit and loss account or in my balance sheet, and then be able to produce the profit and loss account and balance sheet. Now, very often you'll get a skeleton sort of pro forma for your profit and loss account and balance sheet, but it will have very few items in it already. You will have to finish off all of the headings and get the figures in the correct place. So what that means is you need to be very familiar with what goes in your profit and loss account and what goes into your balance sheet. So let's have a look at the pro formas then. So we've got our pro forma profit and loss account. Now, you hopefully remember from AP1 that your profit and loss account is really all about your revenue you've generated in the year and your expenditure that's been generated in the year, netting the two together to end up with your profit or a loss maybe. Now, the first thing to note is that your profit and loss account is headed up as such and always for the year ended, whatever the year end happens to be, in this case the 31st of December 2009. And your profit and loss account can sort of be split into two parts really. You've got this top half, which is sometimes called the trading account. So it's your sales that you've generated from sales of goods or services. And then underneath that you've got your cost of sales. Remember, we've seen that in the incomplete records section, made up of your opening stock plus your purchases, less your closing stock to give you your cost of sales. Taking your cost of sales figure away from your sales revenue generated gives you your gross profit line. In this case, we've got a gross profit of 82,000. So really, that's just saying what's the profit that's generated purely from sales and the costs in order to make those sales, so your purchases of goods or whatever it's cost you to generate the service. Now, underneath that, we've got some sundry income. So what might feature in here is something maybe like bank interest received, or maybe profit on sale of an asset. So it is income to the business. It's not their main source of income. It's nothing to do with their trade. It's just a sort of side income, if you like, that's happened to come along with the money they've kept in their bank account. And underneath that, what we've got is a whole load of expenditure, and sometimes all these expenses are called overheads of the business. Things like rent, rates, salaries, electricity, gas, phone, all those sort of general day-to-day expenses, marketing, that sort of stuff. Other things in there, depreciation, don't forget, that's going to come in there because every year you're going to depreciate your assets to match the cost to the revenue. Bad debts, you've had to write off any bad debts in the year, they're going to slot in there. And also bank charges and bank interest payable, those sort of things, all an expense to the business. Once you've taken all of those overheads off, what you end up with is your net, hopefully a profit for the year, or maybe a loss if your expenses are more than your revenue. In this case, they've made a profit because their revenue was higher than their expenditure. So that's the sort of things you're going to see in your profit and loss account. generally revenue and expenditure. What about our other pro forma then? Well, that's our balance sheet. Now with the balance sheet, again, you'll notice it's headed up as a balance sheet, and it's always as at whatever the year-end date is, because it's just a snapshot of what's going on with your assets and liabilities at a particular point in time. Now remember, this is then split down into two sections, so you've effectively got a top half and a bottom half, and the top half always is going to start off with your assets, and in particular your non-current assets. So when they talk about non-current assets, they mean assets that are going to last for more than 1 year. Okay, so things like property, machinery, vehicles, all that type of stuff is going to start generating revenue for the business over a period of more than 12 months. Underneath that, you're then going to get your current assets. So opposite way around to your non-current then, these ones are going to be due within 12 months. So things like your stock, hopefully you're going to sell that within a year, otherwise you've got a bit of a problem with it. Debtors, again, you're hoping you're going to recover those within 12 months, otherwise again you've got a problem if you can't get your debtors in. And cash, again, hopefully you've got some money in the bank and it's not an overdraft, and that's all an asset of the business. So all that top part talking about your assets, things the business effectively owns. Underneath that then, it's going to come on to talk about the liabilities, and as with the assets, these are split down into two sections. In the first section we're going to look at are the current liabilities, liabilities that are due within 12 months. So trade creditors, for example, they would be due within 12 months. You'd expect your suppliers to want payment within 12 months. Very unusual if they wanted it outside of 12 months. And that will bring you down to your net current assets position. So when you look at your net current assets, that's your current assets minus your current liabilities, give you that net current assets figure. Finally, in your liabilities then, you need to be aware of your non-current liabilities. So anything that's going to be due outside 12 months. So it may be things like a bank loan, but be careful with it. Make sure there isn't any element of it that's due within 1 year, in which case you may have to split it between current and non-current liabilities. All right then, so we've got our net current assets there, we've got our non-current liabilities, and we've got our fixed non-current assets. And when we add all of those up together, taking all of those in, that brings us to what they call our net assets position. So in this case, for this particular company, they've got non-current assets of 50,000, net current assets of 23,000, but they've also got some non-current liabilities to deduct off, bringing them down to 63,000. Now the bottom half of the balance sheet then is really all about the proprietor's interest. So what does the business owe back to the proprietor? And that can be split down again into three parts. So capital, profit and drawings. Now remember, capital is really all about the capital that was initially introduced into the business. Your profits, whatever profit you've made for the year. So if you think about it, when we went back to our profit and loss account here, you notice we made a net profit of 27,500. That profit is then owed back to the owner. So you've got 27,000 coming in there. Obviously they must have made a loss at some point of 500 for that to actually come through at 27,000. Less our drawings for the period of 14,000. So we've got our £14,000 worth of drawings to deduct off. So as the business sort of progresses, the owner needs to take money out of the business, probably to live on, to pay their mortgage, to pay their bills, that sort of thing. So he's taken £14,000 in the year in this case, and that reduces down the amount that's owed back to him because he's effectively taken it. Now, that all adds up to 63,000, and the really important thing to note is that these two amounts balance. So 63,000 in the top half, 63,000 in the bottom half. Always your net assets must equal your proprietor's interest. So that's your two pro formas that you need to become familiar with and think about where you're going to put items in. In terms of exam technique and what you need to be doing, well, first thing to do when you get your trial balance, note down exactly whether you think the item should be profit and loss or balance sheet. So just next to them, jot down P&L or BS for balance sheet. Then, as I say, you'll get a skeleton pro forma, but you need to fill in the details of all the headings for your profit and loss account and your balance sheet. And lastly, insert the figures and add all the statements up, and hopefully your balance sheet will balance. So that's really, in essence, what the financial statements are all about.